Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me to discuss the recent volatility in stocks is Brian Levitt, Global Market Strategist at Invesco. Brian, it's great to see you. Welcome to Trade Talks.
Thank you. Good to be back.
It seems like 2020 has been the year for 3 to 5% moves in one session to the up or downside, which is equally concerning no matter what the direction is. And I think a lot of investors have been caught off guard with the velocity of the sell-off. It's not like in March when there was something to point to, like the COVID-19 shutdowns. Do you think anything materially has changed since last week's sell-off?
No, it doesn't seem like it. I mean, I would just say that the world probably wasn't as good as it felt on Wednesday night and not as bad as it feels this afternoon. The reality is, I mean, there's some seasonal effect here. September tends to be a bad month for stocks, but I would argue that more importantly, we were a little bit overbought. We had a very big run, and we're dealing with some policy uncertainty. And so when you have volatility in markets or drawdowns in markets, it's usually policy driven. In this instance, it's not the Fed. It's coming from fiscal uncertainty. We're waiting to see if there's another plan in place to provide support to households and American businesses. There's the uncertainty of the election. There's the uncertainty of Brexit. There's the uncertainty around reopening policies as we send millions of kids off to school. So it's just an environment where things have gotten overbought in the near term, and policy uncertainty is driving volatility.
What are your thoughts around the latest economic data? Are there areas that appear to be stronger than others?
Yeah, I mean, you're seeing some good signs. I mean, we have to remember that we're coming off of very depressed levels, but we've had a good response, whether you're looking at U.S. retail, which has been reasonably sound, the U.S. housing market looks good, U.S. autos look good. So there's some cyclical components of the U.S. economy that have responded nicely. Now, the reality is this is not going to be a robust recovery. What we're looking for here going forward off of these what had been a response off of very depressed levels is to see some gradual, modest improvements in economic activity. And that's going to take the reopenings going well, keeping cases relatively compressed, and re-engaging with more and more parts of the economy. It'll happen with fits and starts, but we suspect that over the next year, we will see more of this recovery take hold.
So longer term, it sounds like we'll remain in a risk-on environment, if you will. What are the new business and market cycles that have emerged?
Yeah, so new business and market cycles emerged coming out of the deep recession that we had, and you saw a lot of signs with that: inflation expectations up, corporate borrowing costs down, the dollar weaker. So you got all of those signs that a new cycle was emerging. And while this cycle may emerge with some fits and starts along the way because of the uncertainty around the COVID outbreak, we believe that betting against the recovery is betting against medicine, betting against science, betting against human ingenuity. So this economy will recover. It'll take a long time. I mean, we've got millions of unemployed. We've got a pretty extended output gap. It's going to take a while. But what I would remind investors is think about where they were in 2008 and 2009. By 2009, a new cycle had emerged. The markets had sniffed it out ahead of time. And a lot of investors were concerned that things didn't look great in the economy. Things didn't look great in the economy for a long time. And yet between 2009 and 2013, we staged a very significant advance. This could be similar in that things in the economy may not look great for a while, but there will likely be gradual improvements at a time when policy is very accommodative, stocks are cheap to bonds, real yields are negative. All of that should be supportive for the equity market. So it may not feel great on Main Street for a while, but markets should continue to push higher over the next year and beyond.
Let's go back to the US national election because outside of COVID-19, the financial markets will clearly be focused on the outcome there. What's more impactful, a Republican or Democrat to the market or state of the economy at the start of the new turn? It's not necessarily the outcome of who wins, but where the economy is.
Yeah, I think starting points matter more than the outcome of the election. That might not be popular in all circles, but what I give as an example is just think about Reagan and Obama. Reagan and Obama were both presidents for 8 years and had returns of over 15.5% per year during their terms. Now, you ask most Americans what did they have in common, you'd probably hear not a whole lot. What I think they had in common was they both became presidents during recessions at a time when stocks were historically cheap, when the Fed was fighting a major problem in society, and when we had a pretty good demographic wave. So my opinion, whether it's Joe Biden or whether it's Donald Trump, both of those gentlemen are going to have similar starting points in that we're coming out of a recession. Stocks are historically cheap to bonds. The Fed's fighting a major problem in society, which is the big unemployment that has built up as a result of the COVID outbreak. And we've got a good demographic wave, which is to say a lot of Americans turning 30 over the next 4 and 8 years. So in my opinion, that matters more. I adhere to the adage, don't fight the Fed. I also adhere to the adage that hating the government is not an investment strategy. And so my opinion, don't fight the Fed. I mean, if we're gonna be in a negative real yield world persistently, then we're gonna need to do something with our money, or else we're gonna be growing poor slowly. And the way what we do with our money is likely favor stocks over bonds and credit over treasuries.
All right, all great points. Brian, thanks so much for joining us on Trade Talks.
Thank you.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.